You have probably been told to max out your 401k or contribute to a Roth IRA, but what if I told you there is a way to buy rental property, invest in apartment buildings, and build real estate wealth, all inside your retirement account, and pay little to zero taxes on the income or the gains? Sounds like something only the ultra-wealthy can do, right? Not true. In 2025, regular investors are tapping into this exact strategy, and if you are not using it, you are leaving thousands on the table. Let's break down how to legally buy real estate through a self-directed IRA or a solo 401k, how to avoid the most common tax traps, and how to set it up correctly, step by step. Most people think retirement accounts are just for mutual funds and stocks. Your 401k or IRA can be used to invest in real estate, syndications, private lending, and even flips, all with powerful tax advantages. It's called a self-directed IRA or a self-directed solo 401k. And this is how investors are earning tax-free rental income, deferred capital gains, and avoiding the volatility of the stock market while building generational wealth. Here are its advantages. You can use retirement money to diversify into real assets. Your rental income grows inside a tax-advantaged container, and when done right, you can eliminate capital gains taxes. Now let's talk about what tools you need to make this happen. So, how do you invest in real estate with a retirement account? The first step is setting up the right kind of account. Traditional IRAs and 401ks through big banks or brokerages don't allow real estate, so you will need one of two options. Option 1, a self-directed IRA or SDIRA. This allows you to invest in rental property, notes, land, or even crypto, as long as you follow IRS rules. Option 2, having a self-directed solo 401k, perfect for self-employed people or those with side businesses. This gives you even more flexibility, higher contribution limits, and a major tax benefit we'll talk about shortly. Once the account is opened with a custodian, you roll over your funds and direct them toward your investment, whether that's buying a rental, funding a syndication, or lending on a deal. Moving on, why wealthy investors love the solo 401k. Here is a little known fact. The solo 401k offers a huge advantage over the self-directed IRA, and it has everything to do with something called UDFI. Let me explain. If you use leverage inside an IRA, like taking out a mortgage to buy real estate, the IRS hits you with a tax called Unrelated Debt-Financed Income, or UDFI. It can be up to 37%, even inside your retirement account. But with the solo 401k, it's totally tax exempt. That's right. If you buy real estate with a non-recourse loan in a solo 401k, no UDFI tax applies. So, the wealthy and savvy investors use solo 401ks to buy leveraged real estate without paying taxes on the financed portion of income. Now that's how you scale. Let's look at a real-life example. Imagine this. You roll over $150,000 into a solo 401k. You buy a $400,000 rental property with a 62% non-recourse loan. You earn $2,500 per month in rent, cover expenses, and net $500 a month. Because this is inside your 401k, that $500 a month grows tax-free. You reinvest it, buy more property, and when you sell, no capital gains tax if it's a Roth solo 401k. Also, if you held the same property in a taxable LLC, you'd owe tax on net rental income, capital gains on the sale, possibly self-employment tax if it was a short-term rental. With a solo 401k, you legally avoid all three. But wait, there are IRS rules you must follow. This strategy is powerful, but there are very specific rules you must follow, or the IRS could disqualify your account. These are called prohibited transactions, and breaking even one can blow up your retirement account. Here is what's off limits. You can't buy a property and live in it, or let family members live there. You can't buy from or sell to yourself or a family member. All income and expenses must flow through the retirement account, not your checking account. So think of it like this. You are the investor, not the manager. Keep it clean, documented, and at arm's length. Let's talk about UBTI, the other tax most people miss. While UDFI is about leverage, there is another sneaky tax called UBTI, Unrelated Business Taxable Income. This kicks in if your retirement account is involved in an active business, like flipping houses, Airbnb hosting, or investing in operating partnerships. If the IRS deems your activity business-like, they will tax it, even inside the IRA or 401k. That's why real estate held in these accounts should be passive, long-term, low turnover, and again, the solo 401k gives you more flexibility because UBTI is often easier to manage through 401k rules than IRA rules. This is why tax planning before you buy is essential. Wrapping it up, why this strategy is so powerful in 2025. In 2025, with inflation, rising taxes, and market volatility, investors are hungry for alternatives that give them stable income, tax protection, long-term growth, diversification from Wall Street. Using your IRA or 401k to invest in real estate gives you all four, and it's 100% legal when done right. This is how the wealthy compound their wealth tax-free, not just by making more money, but by keeping more of what they earn. And now you can do it too. If you are ready to use your retirement funds to buy real estate, but don't want to get crushed by UBTI, UDFI, or the IRS rules you didn't know existed, book a strategy call today at Gavtax.com. We will help you choose the right account type, structure your deals, avoid the landmines, and unlock tax-free growth from your real estate portfolio. If this video helped, give it a like, subscribe, and share it with another investor who is still stuck in index funds. Thanks for watching, and we will see you in the next one.